Most people think investing starts when you have thousands of dollars. But the truth is, your first $100 might be more important than your first $10,000. Not because $100 is going to make you rich overnight. It won't. The real value of your first $100 is that it teaches you how the system works. It teaches you how money moves from your bank account into an investment account. It teaches you how to choose an asset. It teaches you how to deal with risk. And most importantly, it helps you build the identity of someone who invests consistently. So in this video, I'm going to break down exactly how a beginner can start investing with $100, what to avoid, and how to turn that first small move into a long-term wealth-building habit. This is Wealth Rookie Lab, where we break down simple money moves and real wealth habits for beginners. This video is for educational purposes only and is not financial advice. The real goal of your first $100. Let's start with the most important idea. Your first $100 is not about becoming rich. Your first $100 is about becoming dangerous with the basics. Most people never start because they think they need the perfect time, the perfect stock, the perfect app, or a huge amount of money. But investing is a skill, and like most skills, you do not master it by watching forever. You learn by taking a small, controlled first step. With your first $100, the goal is to learn 4 things. First, how investment accounts work. Second, how to research basic investments. Third, how to understand risk before you put money in. And fourth, how to repeat the process every month. That last one matters the most, because one $100 investment is a start, but $100 invested consistently becomes a system. And wealth is usually built by systems, not random motivation. Handle your financial base first. Before we talk about where the $100 could go, we need to talk about your financial base, because investing while your financial life is on fire can create problems. If you have no emergency savings, unstable income, or high-interest debt, you may need to pause before putting money into the market. That does not mean you are failing. It means you are building in the right order. Think about it like fitness. You would not max out on squats if your form is terrible and your knees are hurting. You would fix the basics first. Money works the same way. If a small emergency would force you to sell your investment immediately, then that investment may not really be ready to grow. So before investing your first $100, ask yourself 3 questions. Question 1, do I have at least a small emergency cushion? Question 2, do I have high-interest debt that is draining me every month? Question 3, can I leave this $100 alone without needing it next week? If the answer to all 3 is yes, then you may be ready to start learning the investing process. If the answer is no, your first $100 might be better used to build a starter emergency fund or reduce expensive debt. That is still a wealth-building move. Not every smart money move happens inside a brokerage account. Choose the account before the investment. One of the biggest beginner mistakes is asking, "What should I buy?" before asking, "What account should I use?" The account is the container. The investment is what you put inside the container. For beginners, there are a few common account types to research. The first is a regular taxable brokerage account. This is usually flexible. You can buy and sell investments, and you are not locking the account to retirement rules in the same way some retirement accounts work. The second is a Roth IRA. A Roth IRA is a retirement account that may offer tax advantages if you follow the rules. But it has eligibility rules and contribution rules, so you need to check whether it fits your situation. The third option is an employer retirement plan, if you have access to one. If an employer offers a match, that can be a powerful benefit to research. The key idea is this: do not just open a random account because someone online said it was good. Understand the purpose of the account. Is it for retirement? Is it for flexible investing? Is it for a specific goal? The account should match the mission. Keep the first investment simple. Once you understand the account, then you can think about the investment. And for your first $100, simple is usually better. A lot of beginners immediately want to find the next explosive stock. They want the stock that turns $100 into $10,000. That mindset is exciting, but it can also be dangerous. Because when you are brand new, you are not just risking money, you are also training your habits. If your first habit is chasing hype, you may become addicted to gambling instead of investing. So instead of starting with hype, research broad, diversified investments. One example many beginners study is an ETF. An ETF can hold many investments inside one fund, which can help reduce the risk of depending on one company. That does not mean ETFs are risk-free. They still move up and down, but they can be easier for beginners to understand than trying to pick individual winners from day one. Another beginner-friendly concept is fractional shares. Fractional shares allow you to invest smaller amounts into certain assets instead of needing enough money to buy a full share. That can make $100 more useful than it used to be. The main point is not that you must buy one specific thing. The point is to avoid making your first move based on hype, fear of missing out, or a random comment section. Research first. Understand what you are buying. Know why you are buying it, and know what would make you stop buying it. Build the habit, not just the portfolio. Now let's talk about the part that most beginners ignore, the habit. If you invest $100 one time and never touch your plan again, you learn something, but you did not build a system. The real power starts when investing becomes automatic and repeatable. For example, maybe your first goal is not to invest thousands. Maybe your first goal is to invest $25 every week, or $50 every paycheck, or $100 every month. The number depends on your situation, but the system is the same. Earn money, control spending, keep an emergency cushion, invest consistently, repeat. That is not flashy, but it is how a lot of real wealth gets built. And this is where most people get it wrong. They think investing is about finding one perfect move. But for beginners, investing is usually about becoming the kind of person who keeps making solid moves over a long period of time. Your first $100 is just the first rep. Avoid these beginner mistakes. Before we wrap up, here are a few mistakes to avoid. Mistake number 1, investing money you need for bills. If rent, food, gas, or an emergency depends on that money, it probably should not be in the market. Mistake number 2, copying influencers without understanding the risk. Someone online may show profits, but they may not show losses, debt, taxes, or the full account history. Mistake number 3, thinking a Roth IRA or brokerage account automatically invests your money. Opening the account is one step. Funding it is another step. Choosing investments inside the account is another step. Mistake number 4, checking the account every 5 minutes. If your plan is long-term, constant checking can make you emotional and impatient. Mistake number 5, chasing advanced strategies too early. Options, margin, leverage, and risky trades can be useful for some experienced people, but they can wreck beginners who do not understand them. Learn the basics first. Protect your capital, then earn the right to study more advanced strategies later. Simple first $100 checklist. Here is a simple checklist for your first $100. Step 1. Make sure you do not need the money immediately. Step 2. Build or start building a small emergency cushion. Step 3. Research which account fits your goal. Step 4. Study simple diversified investments. Step 5. Invest only after you understand what you are buying. Step 6. Set a repeatable contribution goal. Step 7. Track your progress monthly, not emotionally every hour. If you can do that, your first $100 becomes more than a small amount of money. It becomes proof that you are building a new habit. Closing. So if you are waiting until you have thousands of dollars to start learning investing, you may be waiting too long. You do not need to be rich to start learning, but you do need to be responsible. Handle your base. Choose the right type of account. Keep the first investment simple. Avoid hype. And build the habit of investing consistently. That is how $100 becomes the first step in a much bigger plan. If you want more beginner-friendly money breakdowns, subscribe to Wealth Rookie Lab and comment below with this question. If you had $100 to improve your financial life, would you save it, invest it, pay debt, or start a side hustle? I'll see you in the next video.